Mark Sturdy here with 7 days ahead's highlights of their technical strategies this week, 25th of January 2022. Since we wrote the analysis yesterday, there have been some big moves in the stocks, and I'll come to that presently. But for the moment, let's concentrate on the currencies, and the summary suggests that we're still bearish of the euro against the dollar, and we're bearish of the yen against the dollar. Our analysis there is, as before, continuing weakness from this turn of the market here, the turn taking place at the prior resistance from these lows going way back to 2006 and 2012. The market's failed to make progress through there, and they've driven it down. The market is being maintained in a bearish fashion for the euro because of this double-headed head and shoulders top, which we think will drive us down to about 109 minimum. We have been going sideways, but note the attempt to go a lot better for the euro failed where we thought it might, at the band of resistance from successive lows. The yen is much the same. We are bearish of the yen to go higher against the dollar. We have been driven in the long term by this bull falling wedge and a triangle here, continuation triangle, the top of which is acting as good support. So, despite the fact that the market's been going sideways for some while, we remain bearish of the yen. Now, turning to the stocks, a lot has happened since we wrote this yesterday. We were bearish. We spoke about bearish evidence growing early on Monday, and we were suggesting people should watch carefully for a possible monthly key reversal. But there's already a weekly breakdown in the S&P that we talked about. This was on Monday. It broke down through 45.49. We're not surprised, therefore, that it's gone further. The market's now trading around, been trading around to 4,300, 42.50. Out and out bearish with the S&P until such time as on the week the market closes beneath 45.49. We do note that the minimum move of this top formation, we noted this yesterday, is somewhere down to 4,200 and 4,250. So, in large part, the market has very quickly already achieved the target on the downside, the short-term target we wrote about on Monday. It's actually a low yesterday, in the sell-off of yesterday, of 42.12. So we more or less have made this the vast proportion of the immediate target that arose from this multiple top. That's one good reason to be a bit cautious about suggesting further sales from here quickly. But we are left with the recurrence of bearish indicators, weekly key reversal there, weekly key reversal there. And just to go back to the monthly chart, monthly key reversal here and a monthly key reversal there. So there are bear signs. The market may go further. We can't be that bearish down at 42.50, 4200, because that is a level that has exhausted the bearishness that was implicit in this top formation. Looking at the other markets, there are other reasons to be cautious on the bear tack. The Euro stocks, we noted, is a relatively strong long-term position because of these massive supports from prior highs. The market in the Euro stocks has got down to this level, but it hasn't broken these levels yet. So it remains within a weekly and long-term, above a long-term support, and within a weekly trading range. Of course, we're a lot lower than we were early on Monday. We're down around 4,000. Similarly, the Nikkei 225. We have enormously good support beneath the market here from this very, very long-term, very bullish structure beneath the Nikkei we've been talking about for some while. It calls it up on a quarterly chart to just below 40,000. We noted that there was a trading range here, and there's no question that the short-term moves have put us down beneath here. But it's the close on the week that we should watch carefully in terms of if there's a close on the week above 27,000, which is perfectly possible in the Nikkei, we would be cautious about selling hard. We need a breakdown of these levels of 27,000 on the week to really get the bears going. And so, on to the bonds. We were excited by the bond market, looking at the leading US Treasury note bond market. We think it's bullish, and we're particularly bullish of yield because of the completion of this continuation triangle on the upside. The market's largely unchanged from where it was when we wrote on Monday. And so we're still bulls of this, and we're looking for the market to go up to 2.3 yield, which is a move of nearly 0.5%. Exciting. The short-term resistance is still in place. The market is up slightly higher, but this band of resistance above the market in the futures market is still there. So we remain bearish of the prices and bullish of yields. Much the same in the Bund and the gilt. I think the other exciting point from our summary is that we are bullish. There we have the bullishness of the US note, which will remain in all time frame. Here is the oil. Let's quickly look at the oil. The monthly chart looks exciting if we can close high above these levels. The weekly chart is interesting. We are beneath 83.83, and so we're looking for a close on the week above 83.83 for the bull momentum to be maintained. The market remains above 80.72 in the March futures right now. So it has pulled back, but not beneath 80.72. A close above that on the week in the March futures would be especially bullish. Gold hasn't moved a great deal in the bearishness of stocks in the way that formerly we might have expected. It is still above the support 1835, so we're small bullish there in the very short term. But the wide trading range in the medium term robs us of any real excitement. Thanks very much.